750 million people trust Apple with their face, their fingerprints, and their credit cards. Now imagine, just for the next 60 seconds, that every single one of those people has a Bitcoin wallet. Not in 5 years. This year, the infrastructure for that already exists. Apple is just waiting for the moment. Apple just filed something that no major financial media outlet is talking about. And if you understand what it actually means, not the surface level explanation, but what's happening underneath, your view of Bitcoin, crypto, and the entire global payments infrastructure is about to shift permanently. Let me be clear about something before we get into this. This is not speculation for the sake of drama. What I'm going to walk you through today is a convergence of corporate signals, Federal Reserve policy, global liquidity cycles, and institutional positioning that points to one of the most consequential potential shifts in the history of digital payments. And Apple sits right at the center of it. So stay with me, because in the next 20 minutes, I'm going to show you exactly what Apple appears to be moving toward, why the timing right now is not a coincidence, what the Federal Reserve's current posture has to do with any of this, and why smart money is already positioning before the general public even knows the question exists. If this is your first time on the Wealth Continuum, this channel exists for one reason: to give you the macro-level analysis that institutional investors use to make decisions, translated into language that actually makes sense. We don't do noise here, we do signal. So hit that subscribe button right now, because what's coming in the next few months in crypto, payments, and monetary policy is going to move fast, and you are going to want to be ahead of it. Now, let's talk about Apple. As of February 2026, Apple's market capitalization sits at approximately $3.7 trillion. Let that number breathe for a moment. $3.7 trillion. That makes Apple not just the most valuable company in human history. It makes Apple larger than the GDP of most sovereign nations on this planet. Germany, the United Kingdom, India. Apple's market cap rivals or exceeds entire national economies. And yet, for all that scale, Apple still processes 0 direct crypto transactions. That sentence is important. Sit with it. Apple Pay handles over 750 million users globally. The App Store generates tens of billions in annual revenue. Apple Card, Apple Cash, Apple Savings. The company has been quietly, methodically building one of the most sophisticated financial services ecosystems ever assembled by a technology company. And every single piece of that infrastructure runs through traditional banking rails, legacy systems, the same ACH networks, Visa and MasterCard interchange fees, and SWIFT-adjacent architecture that was designed in the 1970s. That may be about to change. And the signals have been building for longer than most people realize. Here's what most investors are missing. The question is not whether Apple will eventually integrate crypto payments. The real question is, has Apple already begun the internal groundwork? And are we simply watching the early signals before anything is made public? Because when you start connecting the dots, the regulatory environment shifting under the new administration, the Bitcoin ETF infrastructure now fully mature, the stablecoin legislation moving through Congress right now, and Apple's own behavior over the past 18 months, the picture that emerges is not a definitive answer. It looks like the beginning of a very serious question. Let me show you the evidence, and I'll be clear throughout about what is confirmed versus what is interpretive analysis. The antitrust environment surrounding Apple has been one of the most consequential regulatory stories of the past 3 years. The Department of Justice, the European Commission, and multiple state attorneys general have applied sustained pressure on Apple's payments ecosystem, specifically targeting the degree of control Apple exercises over how money moves through its platform. App Store payment restrictions, developer fees, the lock-in around Apple Pay, these have all faced serious regulatory scrutiny. What matters for our story is not a single settlement or ruling. What matters is the cumulative direction of that pressure. Apple has been forced, across multiple jurisdictions, to open its payments infrastructure to third-party competition in ways it never anticipated. That regulatory shift, that loosening of Apple's grip on how transactions flow, creates an opening, not a guarantee, an opening. And in the context of crypto, that opening is meaningful because it reduces the regulatory risk that previously made a crypto-native payment feature almost impossible to launch without triggering immediate regulatory blowback. In other words, the antitrust story is not the smoking gun. It is the clearing of the brush. And with the brush cleared, the question becomes, what does Apple build next? Then there are the patent filings. And this is where I want to be precise, because patents are evidence of exploration, not confirmation of a product roadmap. Apple files thousands of patents every year. Many never become products. Some sit dormant for a decade before surfacing. That said, patents do tell you what a company is thinking about, what engineering problems it is paying engineers to solve, and what future capabilities it may be quietly building toward. With that context clearly on the table, A series of patent filings from Apple as engineering division, surfacing over the past 18 months, describe cryptographic key management systems that appear designed for embedding within the secure enclave of Apple silicon chips. The filings include claims around hardware-level private key storage, multi-signature authorization protocols, and what the filings describe as decentralized payment verification architecture. If those concepts were ever translated into a shipping product, what they would suggest is an iPhone that could function as a crypto hardware wallet, or with the same level of security that currently requires a dedicated ledger or Trezor device, but embedded directly into the phone you already carry. Again, patents are not products. Apple may never ship any of this, but the direction of the engineering investment is notable. Companies spend money solving problems they intend to eventually use. 750 million active Apple Pay users, 750 million potential crypto wallets. If, and this is a significant if, Apple ever activates that capability, that conditional matters, hold it. Now here's where most people stop the analysis. They see the patents, they hear about the regulatory changes, and they think, okay, Apple might add a Bitcoin wallet one day, that's interesting. And then they move on. They don't ask the deeper question. The deeper question is, why does the macro environment right now make this more plausible than it was in 2021 or 2022 at the height of the last crypto cycle? Because Apple could have explored this earlier. They didn't, or at least they didn't make it visible. Something has changed, and that something leads you directly to the Federal Reserve, and to a liquidity story that almost nobody in the mainstream crypto space is talking about coherently. Stay with me, because the next part changes everything. The Federal Reserve's current policy posture, as of February 2026, is one of the most consequential in the institution's modern history. After the aggressive rate hiking cycle that began in March 2022 and peaked with the federal funds rate reaching roughly 5.25 to 5.5%. In mid-2023, the Fed has been navigating a complex, multivariable easing cycle. By the end of 2025, rates had come down to approximately 4 to 4.25%. Not an aggressive cut, but a deliberate measured reduction that reflects the Fed's attempt to thread an incredibly narrow needle. Inflation, while substantially lower than its 2022 peak of over 9%, has proven stickier than the Fed's models predicted. Core PCE, the Fed's preferred inflation measure, has in recent months remained stubbornly above the Fed's 2% target. That puts the Fed in a position where it cannot cut rates aggressively without risking a second inflation wave, but it also cannot hold rates at restrictive levels indefinitely without crushing commercial real estate, regional banks, and the broader credit market. This is the macro machine that Apple is watching. Not because Apple is a financial services company, at least not yet, but because Apple understands something that most retail investors do not. The Federal Reserve's current policy environment is creating structural demand for alternatives to dollar-denominated financial products. And that demand is the oxygen that feeds the crypto payments narrative. When interest rates were near zero in 2020 and 2021, holding dollars in savings accounts returned essentially nothing. People searched for yield. That drove them to crypto, to equities, to real estate, to anything that wasn't cash. Then, when rates spiked, cash suddenly paid 5% and risk assets suffered. Now we're in a middle period. Rates are coming down, but slowly. Real yields, the difference between nominal interest rates and actual inflation, are tightening. In this environment, the value proposition of holding dollars weakens again, and the appeal of programmable, borderless digital money strengthens. Apple's product team is not naive to this. They are one of the most sophisticated product organizations in corporate history. They don't launch products into headwinds. They identify tailwinds and build toward them. The macro tailwind for crypto payments is not a future event. It is already building, and Apple appears to be paying close attention. You need to understand this before I show you what happens next. The stablecoin market has undergone a transformation that is genuinely difficult to overstate. The total stablecoin market cap has grown dramatically over the past 2 years, crossing approximately $200 billion and continuing to expand as of early 2026. Tether's USDT remains dominant. Circle's USDC has grown substantially, particularly in institutional and cross-border contexts. And new entrants, including stablecoins backed by major financial institutions, have entered the space with regulatory approval under frameworks that simply didn't exist 2 years ago. The stablecoin legislation working through Congress, what many are calling the Stable Act in various iterations, is getting closer to a final form. And what that legislation would do, in practical terms, is create a legal framework under which a company like Apple could integrate a regulated stablecoin into its payments ecosystem without the kind of regulatory ambiguity that previously made that move commercially unviable. Think about what Apple integrated stablecoin settlement could mean. Not Apple issuing its own speculative token. That's not what I'm describing. I'm describing the possibility of dollar-pegged stablecoin settlement embedded in Apple Pay transactions, where instead of routing through Visa's network, collecting interchange fees, settling 48 hours later, the transaction could settle in seconds, on-chain, for fractions of a cent in fees. For merchants, that's transformative. For Apple, that could be a revenue model that doesn't depend on Visa or MasterCard at all. Hit, like, if you think this is bigger than most people in your circle realize, because I want to know how many of you are actually paying attention to the architecture of what may be being built right now. Let's talk about Bitcoin specifically, because Bitcoin doesn't fit neatly into the stablecoin payments narrative. And yet, it is inextricably linked to the story I'm telling you. Bitcoin has been trading in the rough range of $90,000 to $105,000 per coin in recent months, digesting the extraordinary run that followed the US presidential election in November 2024 and the subsequent pro-crypto regulatory pivot from Washington. The new administration is executive orders, which included directing relevant agencies to treat certain digital assets as strategic economic interests, created a regulatory landscape that is fundamentally different from anything that existed in the prior framework. The Bitcoin ETF ecosystem, which launched in January 2024, has now been operational for over 2 years. Cumulative net inflows into spot Bitcoin ETFs in the United States have been significant, with rough estimates in the tens of billions of dollars across all products. BlackRock's iShares Bitcoin Trust, ticker IBIT, became one of the fastest growing ETF products in Wall Street history. Total assets under management across all US spot Bitcoin ETFs have grown to levels that would have been unimaginable just 3 years ago. What this represents is not just institutional participation, it's institutional normalization. When the largest asset managers on Earth are holding Bitcoin in their ETFs, when pension funds are beginning to allocate fractional percentages of their portfolios to Bitcoin as a macro hedge, when sovereign wealth funds are quietly exploring exposure, the narrative around Bitcoin as a fringe asset has collapsed. Bitcoin is in the institutional plumbing, and that plumbing now connects directly to the financial infrastructure that Apple operates within every single day. Here is where it gets concerning for anyone who still believes this story is small. The major custodians of Bitcoin ETF assets in the United States already operate within ecosystems that Apple engages with through existing financial services partnerships. The infrastructure for Apple to explore Bitcoin-related features, whether for merchant acceptance, peer-to-peer transfers, or savings functionality, is not being built from zero. Much of it is already adjacent to relationships Apple already has. Let me bring you back to the macro picture because I want you to understand the global dimension of this story. This is not just an American story, and that matters for how you think about the positioning. The US dollar's share of global central bank reserves has been declining for over a decade. In 2001, the dollar represented approximately 73% of global foreign exchange reserves. That figure has declined meaningfully since, according to IMF COFR data that anyone can verify. Countries across the global south, Southeast Asia, parts of Latin America, and the Middle East are actively exploring ways to conduct bilateral trade that reduces dependence on dollar-based settlement systems. This is not a fringe theory. It is documented in publicly available data. In that environment, a dollar-denominated stablecoin that settles on a blockchain, crossing borders in seconds, without correspondent banking relationships, without SWIFT delays, without currency conversion friction, becomes an extraordinarily attractive tool, not just for American consumers, for the entire world. And who controls the device that hundreds of millions of global users trust for mobile payments? Apple does. A US government that is currently both pro-crypto and pro-dollar dominance would have real strategic incentive to see Apple move in this direction. This is one of those rare moments where corporate interest, regulatory environment, geopolitical strategy, and technological readiness may all be pointing in the same direction simultaneously. When you see that kind of potential alignment, you take it seriously. Share this video with one person in your life who is still on the sidelines of the digital asset conversation, because the sidelines may be getting smaller. Now let's talk about smart money, because this is the layer of the story where the rubber meets the road for your actual portfolio thinking. The institutional activity in crypto over the past 6 months has been notable. Open interest in Bitcoin futures on the CME, the Chicago Mercantile Exchange, which is the regulated futures market that institutional investors use, has reached elevated levels by historical standards. The options market has leaned toward call-side positioning in recent months, which broadly suggests the market is expressing a probability-weighted view that Bitcoin's price will be higher in the future than it is today. Options markets are forward-looking mechanisms, and the current positioning is meaningful. On-chain data adds another layer. Wallet addresses holding substantial Bitcoin quantities have been accumulating in recent quarters. Exchange net flow data shows more Bitcoin moving off exchanges into cold storage than moving on exchanges for potential sale. Supply appears to be tightening, And if demand increases from a catalyst, whether Apple, a regulatory shift, or another institutional adoption event, the supply-demand dynamic could tighten very quickly. Retail sentiment, as measured by search trends and exchange registration data, appears elevated but not at the manic levels that typically precede major corrections. The market is not in a state of irrational exuberance. It appears to be in a state of informed anticipation. That distinction matters enormously. But before we get to the forward scenarios, I want to do something that most finance channels won't do. I want to be honest about what could stop this story entirely. Because credibility requires it, and frankly, these risks are real. Apple faces 4 genuine structural barriers to crypto integration that should not be dismissed. The first is regulatory complexity. Even with a friendlier US administration, Apple operates in over 170 countries. The EU, the UK, China, India, each has its own evolving digital asset regulatory framework. Building a globally compliant crypto payment feature is not a single engineering problem. It is hundreds of simultaneous regulatory problems, some of which are genuinely unsolved. The second barrier is volatility exposure. Apple Pay works because a dollar is a dollar at the moment of transaction. Bitcoin's price can move 2 to 5% in a single hour. For merchant adoption, that volatility is a serious friction point. Stablecoins solve this for dollar-pegged transactions, but they introduce their own regulatory and counterparty risks that Apple's legal team would scrutinize intensely. The third barrier is user experience complexity. Private keys, seed phrases, wallet addresses, network fees. These concepts are still deeply unfamiliar to the average iPhone user. Apple has always prioritized frictionless experience above everything else. Building a crypto feature that doesn't confuse, frustrate, or expose its 750 million users to loss risk is an extraordinarily difficult design challenge. It is solvable, but it has not been solved at consumer scale by anyone yet. And the fourth barrier is fraud and liability exposure. If users lose funds due to a crypto transaction error, a scam, or a technical failure, who is liable? Apple currently has extensive consumer protections built into Apple Pay. Crypto's irreversible, trustless settlement creates a liability structure that is fundamentally different. Apple's legal and insurance teams would need to completely rethink how consumer protection works in a crypto-native environment. These are not small problems. They are the reason Apple has not moved on this yet, despite clearly having the technology, the scale, and the financial services infrastructure to attempt it. So when I walk you through the forward scenarios, hold these risks in your mind. The bull case is real, so are the barriers. Now, let me give you a realistic framework for thinking about what might happen next. Not a prediction, because anyone who claims certainty in markets is usually either overconfident or selling a narrative, but 3 scenarios that represent the most realistic range of outcomes over the next 12 to 18 months. Scenario 1 is what I'd call the full integration play. In this version of events, Apple Inc. announces native crypto functionality inside Apple Wallet and Apple Pay, likely starting with stablecoins, with Bitcoin added as a secondary feature. There is no confirmed timeline today, but if such an announcement arrived within an upcoming product cycle, the announcement alone, not the rollout, could trigger a major repricing across the crypto market. We already have a rough template for this kind of validation event. When spot Bitcoin ETFs were approved in 2024, the impact wasn't just technical, it was psychological. It signaled institutional legitimacy. Apple operates at an even larger consumer scale, so a similar catalyst could drive fast and significant movement across digital assets broadly, with assets like Ethereum and crypto payment infrastructure potentially reacting even more aggressively. Scenario 2 is the incremental approach. Instead of full integration, Apple could begin with a narrow stablecoin use case, most likely international payments or remittances. This would allow the company to test regulatory reactions and user behavior without committing to a broader crypto rollout. This path carries lower risk and fits Apple's historical strategy of gradual ecosystem expansion. Market impact in this scenario would still be meaningful but more measured. Stablecoin infrastructure would benefit most directly, while Bitcoin's move would likely be narrative-driven rather than structurally driven. It would produce an immediate explosive price event, but it could quietly set up a much larger shift later. Scenario 3 is that nothing happens on this timeline. Stablecoin legislation could stall, regulatory compliance could become too complex, or a broader macro shock, credit stress, banking instability, or geopolitical risk could push risk assets lower and shift corporate priorities away from crypto integration entirely. In that scenario, the crypto market likely corrects meaningfully, and the Apple narrative becomes a future cycle story rather than a current one. None of these outcomes is certain. All 3 are genuinely possible. But the weight of circumstantial evidence suggests that movement in this direction is more plausible today than it was even 2 years ago. At the same time, scenario 3 must remain in your peripheral vision, because markets consistently punish conviction that lacks humility. If you want follow-up analysis as this story develops, subscribe to the wealth continuum. Because when something material changes, regulatory, corporate, or macro, I'll break down exactly what it means. Now there's one more layer to this story, and it connects everything we've discussed. We are living through a period of structural monetary transition. The Federal Reserve is managing an economic system carrying more than $36 trillion in U.S. debt. That reality limits how aggressively interest rates can rise without creating instability elsewhere in the financial system. Over time, this creates structural pressure on the long-term purchasing power of fiat currencies. In that environment, Bitcoin's core value proposition, fixed supply, no central issuer, mathematically enforced scarcity, begins to look less like speculation and more like a macro hedge. Institutional capital increasingly understands this. The rise of Bitcoin ETFs is not just a product trend, it reflects a broader shift in how large investors think about portfolio construction. This is why Apple's potential involvement matters so much. If Apple integrates crypto payments, it wouldn't just be another product launch. It would be the moment digital assets move from alternative to familiar. Hundreds of millions of people who already trust Apple with their financial and personal data would suddenly have access to crypto functionality built directly into the devices they use every day. And in markets, when something moves from unfamiliar to normal, that's when the largest repricing events tend to happen. You do not want to be figuring out your positioning the morning after that announcement, if it comes. The setup is real. The evidence is building. The macro environment is aligned in a way that makes this story increasingly important, even while the outcome remains uncertain. Whether Apple moves in 6 months, 18 months, or later, whether Bitcoin is at 90,000 or 120,000 or lower when the next catalyst arrives, the direction of travel for digital payments is becoming clearer. What isn't clear is whether you'll be ahead of that shift or reacting to it. I don't know when you're watching this. The story may still be unfolding, or it may already have changed. But the real question is no longer whether digital assets will integrate into everyday financial life. The real question is whether you rethinking about that future now or waiting until everyone else agrees it's safe. Because in markets, the moment everyone agrees is usually the moment the opportunity has already passed. Think carefully about that.